Hey everyone, welcome to the KE Report and a company update from Kuya Silver, chatting with the president and CEO David Stein. Big news out of the company yesterday, January 27th. The company has announced a letter of intent to acquire a processing plant, the same plant that is currently processing the material from the Bethania Silver Mine. This really is the next step in vertical integration. Rather than shipping the material off to another company to process, the company, it seems like at least is looking into buying this processing plant. So, David, let's just start off here with the decision after you just raised over $25 million Canadian, the decision now to buy this plant, or probably buy this plant, all subject to due diligence, rather than build your own. Take us through that thought process, please.
Sure. Yeah, I mean, this is an opportunity that we've been looking at pretty seriously just for the past few weeks or maybe more than a little more than a month or two. So it's a relatively recent opportunity, I guess is what I'm trying to say. And we weighed it against building our own plant right now, which we still could do. And the benefit to acquiring an operating plant is that we're up and running essentially right on closing. So it's a seamless transition. We like their plan that they put in place to expand, and we're ready to do that once we close. So we mentioned that in the press release as well. That'll get us our initial phase one target of at least 350 tons per day. That's the plan. And it doesn't actually prevent us from building the Bethania plant down the road at all. If anything, we're just as likely to build the Bethania plant, but we could do it later this year or 2027 and go from 350 to 700 tons per day. So it adds potentially a middle step in our 100-100 plan, which is to go to 1,000 tons per day, although it's actually a cash flow plan, not a production driven target. So we obviously at these silver prices don't have to produce as much to generate that cash flow target of 100 million a year. But nevertheless, we've been presenting this plan for many years, well, for the last year to expand Bethania, to build Bethania phase one and then expand it. And now we potentially have a middle step in there where we can produce, I mean, at our grades, we'd be producing about 3 million ounces a year if we're at 700 tons per day with Bethania plant and Camilla plant going at the same time. So it adds a lot of flexibility, a lot of optionality to the project as we grow, as we add resources, because we're doing a lot more exploration now. And we like that. We like the price. We like the flexibility. We like the optionality. We like the fact that we know the plant already. We've been using it. We've been getting really good recoveries. We know we can do better once it's optimized for our ore type. But the base case has been really, really strong for us.
Walk us through the price then, because there is, I believe, just under $8 million that you would pay here, but then also that expansion from the current 150 tons per day up to that 300 to 350 tons per day. What would the total cost be here?
So if you just add the two, you're looking at about 8.5 to 9 million, I guess, be the number.
The time frame then to increase that capacity.
Well, as you said earlier, we're doing due diligence. I expect that'll take another month or so. We want to, we're not, we're expecting that we're going to get this deal done, obviously, or we wouldn't have announced it. But, we do have a few things that we need to confirm for ourselves. And then from there, once we take control, I think it's a fairly quick process to do that expansion. It's not a lot of equipment. So that cost that we estimated would be the equipment, which is all pretty standard small pieces of equipment that are readily available in Peru, and then plus the labor to construct it, to do the work, which is kind of a one-time cost associated with the expansion. So that would, that's why we're pretty confident we can get all that done before the end of the year. To some degree, it depends on when we close, but it'll all tie into the same timing as we ramp up the mine and get to that 350 ton per day target from the mining operations as well.
So, David, let's say you move through with this acquisition. You already know this plant pretty well. It's already processing the material from Bethania. How does this change economics? How does it change cash flow for the company?
So compared to what we are doing right now, we eliminate the toll milling fee, basically the margin that the toll mill gets from processing third party ore. So because we own it, we obviously pay the costs to run the mill as we would if it was our own mill at site. It's really no different. But the margin or the profit margin that the owners, of the plant would be taking now, that essentially goes away. So we'll save a bit of money there. The trucking costs will be the same as they are right now initially, although as we get more volume, we believe we can negotiate better trucking contracts and reduce that price further. And then there are some other synergies as well, some other offsets that will help with the cost as well. So I guess I might as well go into that. So right now, the cost to truck is, you know, it obviously depends on the grade, but it works out to about $4 or 3.50 per ounce. And that will go lower as we do more trucking. We can essentially have more pricing power on the trucking contracts. Now, so that won't change. There'll be no, additional tolling margin. There is some offsets to that trucking cost though, because the Camilla plant is hooked up to the hydroelectric grid in Peru. So we actually have access to cheaper and green power that we would not have at Bethania. At Bethania, we would be at least starting up for the first few years on diesel because we're not hooked up to the grid there. So that will also save us some money on the energy cost side. And we're also closer to the port at Camilla. So while it's a longer truck haul to get the ore to the mill, it's a much shorter haul for the concentrate, which is a smaller amount, but it's still a cost that we incur. So we'll save something there.
So then, David, as you said, you can still build the other mill or plant if you want, but does that just come down to how you're cash flowing from this? What would hinge on that decision if you do go through this plant expansion, you are making money, then what would make you decide to build a whole other plant?
Well, I believe we're going to need the tonnage. And I think the trade-off of expanding Camilla further to 500 or 1,000 tons per day, it might make more sense to build the Bethania plant and then be in the position to expand that in later years. So I think there's a cash flow component because obviously there will be a cost to this, but we've got a pretty strong balance sheet and we're ramping up into a very nice silver price here. So I think whatever option we decide, we will be able to pay for it. But it's really, we're going to get to a point, I think, later this year where we've got enough resources that we can justify a further expansion beyond 350 tons per day. And then it may make sense at that point to look at building the Bethania plant. For those who read our press release carefully, you might notice we did mention that we are doing the engineering on that plant anyway. We're updating it so that way it is ready to go. Because our costs, at least for our design for the Bethania plant now, are several years old. So we are updating all that at the same time so that we're ready to build that with relatively fresh data, cost points that we can use to budget that when we're ready to go.
So, David, talk to us about production then, because back on the 21st, you reported your Q4 production. Just break down where the company is and what this growth trajectory looks like now.
Well, this plant acquisition won't affect that. I think we are having a pretty good Q1, I understand, with production so far. And however, really the real juicy production is back end weighted because we are doing a lot of development right now as well to get to the other veins and all that stuff that you normally do when you're starting up a mine. So we're doing that work now. Obviously, we're not cash constrained like we were a few quarters ago. We've got plenty of working capital to pay for that development that's necessary. So we're in really, really good shape now. I'm very confident we're going to have some really nice profitability by the second half of the year. And then this plant What it does is it kind of debottlenecks us in the sense that there's always a risk when you're using someone else's plant that it may not be available, et cetera, et cetera. So it puts the ball in sort of firmly in our court to control that process, which we would rather have than the third party. So I think everything's looking really, really good for the second half of the year to be firing all cylinders on the production side.
So from a capital perspective, after raising that $25.5 million Canadian, you pretty good here for continuing to expand, buying this plant, really moving everything forward now that you have this much larger treasury?
Yeah, well, I mean, we actually ended the year with 9 million US on the balance sheet. There is some working capital being invested in Bethania here in Q1, exploration drill program, which is not that much. 1.5 million is what we budgeted for the first quarter, first few months. We've got the ramp starting, the new ramp. That's another sort of special capex item, but again, it's not that much. It's about 1.5 million. So with this plant, if you sort of run the numbers, you'll see that we've got lots left over to have as a bit of a war chest, a buffer, whatever you want to call it. We're going to be able to keep some significant cash on the balance sheet. That will again give us more options. I fully expect the exploration and everything to be paying for itself pretty soon, and then from there we can start looking at capital allocation to the Bethania plant once we have more exploration data to justify that.
Okay, so David, one more question then. When it comes to production and profitability, you know how I always like asking what the company looks like at current metals prices, but the last time we chatted was right before Christmas. And quite frankly, it's a totally different metals price right now as it just continues to run higher. So how does $100 silver change the profitability outlook when you're at break even, when you're cash flowing? Does that change timelines at all?
It does. It definitely does. I mean, we're in the process of rebudgeting, so I'm not going to give any new guidance on this call, but it makes a huge difference in terms of our cash flow. We are processing a batch right now where we might be getting paid 105, 108, 110 per ounce on that, which if we had processed that a few weeks ago in December, we would have got significantly less. So even that one batch, it's going to make a huge difference for us. So yeah, it's definitely good news. I mean, we're not resting on our laurels and expecting silver's going to stay at 100. It might go to 200. It might go back to 70. We've got a great project even at much lower prices. If everybody remembers, we did our PEA at $25 silver a few years ago, and it was a great project at $25 silver. So it definitely is going to help profitability and break even. It's going to pull it much sooner into basically not much sooner into the present, I should say. Yeah.
Okay. Well, I'll follow up with you when we get some of the financial numbers and any other, I guess, forecast that you can share with us when you do share with it. Look, it's a crazy environment to be a silver producer right now, and now you're looking at acquiring the plant that's already processing this ore. If anybody listening has any follow-up questions, please keep emailing me, fleck@kereport.com, and I'll keep following up with David as this story continues to advance. So again, David Stein, President and CEO of Kuya Silver. Company is traded on the CSE under the symbol KUYA, on the OTCQB under the symbol KUYAF, and the Frankfurt Exchange 6MR1. David, thank you for the update today.
Thanks, Corey. Always a pleasure.